Hi there, it's Nick here, and I hope you're awesome. In today's episode, I want to talk about how to use your business to generate cash flow for one of the most important investments that you're ever going to make, and that's called property. Now, a lot of people say to me, Nick, with the extra money that we make from our business, what do we do with it? What's the best way to do it? Now, there's a few different things, but I want you to think about what gives you more income generation. Now, what I love about property is as you sleep, it grows, and pretty much it's got a safe track record over the last at least 40, 50, maybe 60 years plus in Australia. Now, has there been ups and downs? And the answer is yes, but I really like that. It's a touchy-feely. Somebody else can pay the rent for you, which is even better. And number two, it starts to, value in price and goes up. Now, here's the key. So one of the things that I like to talk to my business owners about is to put a little load on anything they do. So let's say, as an example, they're going to sell a product for $1,000. We put another $250 on there, or we take the $250 away from the 1,000. So it looks like profitability looks a little bit lower, but what we're doing with that little load is we're putting it away for property, or it becomes a property fund. Now, are you going to buy a property in the first 2 months? The answer is probably not, unless you're selling a lot of stuff and you're making a lot of income. However, maybe in a year or two's time, if you just slowly start to drip to that, just imagine if you put away $200 a week, right, in a year, right, there's 52 weeks, you're on your way. Right, and then year two, and then year three. Now, how about if you put $300 away a week, 50 weeks, roughly $15,000 at the end of that year. Year two's $30,000. Now, $30,000 gives you a 10% deposit for a $300,000 property. So do you see what happens is you start to accumulate it and compound it. Now, here's what's awesome about property. Let's say you bought the property for $300,000, right? You left it, you just got somebody to rent it, and 3 or 4 years later, you revalued it again. Chances are that it's going to go up probably 5 or 6%, and chances are now you've got some equity in it. So guess what? You might have another 10 or 15,000 you can do. Now, in the meantime, you've actually saved some more money. So you use the equity in the property plus the money that you've saved, and now you've got maybe $45,000 that you can utilize to buy the next one. See, so every 2 years, guess what? You can buy yourself another $300,000 property. That's the best part about it. Now, most property today is either slightly negative geared or neutrally geared. It means you don't have to spend any money, or in some cases, good thing is it's positively geared. Now, I'm not a portfolio expert, but what I can tell you is it's awesome where you've got 5, 6, 7 properties and they all started at the $200 load, right? And so you've got time, you've got years to do it. Just imagine, right, in your career, if you accumulated 10 properties over your career, and now here comes time to retire, and all of these, most of them are going to be paid off for you. It's going to be a really good day. Sound cool? So just remember, your business is there to increase cash flow so you can invest in property. All right, I'm Nick. If you want a little bit of help with that, just let us know. We'll put you in touch with the right guys. We'll go from there. And remember, the only way is